Hey everyone, hopefully you're having a good day. My name's Andy. My channel is Finding Value. Today we're going to go through Twitter, see what people are sharing on social media. I'll interject and sprinkle in my financial opinions as we go through it, generally related to wealth building, commodities, and or financial topics. So let's just dive right in and see what's going on in social media world. If you want to follow me at Financial Square Finance, and if you want to join our community, finding-value.com, where I dive deeper into individual companies, individual sectors, and that is where I share my portfolio, what I'm doing, and why I am mostly doing it during those question and answer session meetings. We do have a midweek update being released today. If you're interested, you can see the midweek update where I basically go over individual companies and give an update of all the sectors that we watch. Okay, so we got rock bottom entries here. Gold divided by silver miners are set up for an overnight gap up. So he's got, I think he said this backwards. This is the Amplified ETF Trust Junior Silver Miner ETF alone. So in SILJ, we could get a move higher here because what he's got is a potential momentum break. Now, this is all short-term market movements. I don't use this for anything in my, outside of taking initial entry points. I don't really follow the short-term market movements like this, but yeah, we could break here, and that's very well a possibility. Holy smokes, we got Drunken Miller here. So Drunk closes Google and Amazon, and he buys gold and increases tech. Tech is a copper company, and CCJ, which is Cameco. So here's gold. We've got Newmont, FCX, which is a copper company, which are all new positions in here. He increased positions of Tech, CCJ, these are all commodity type companies. He closed positions in Rig, Open, Google, Timus, Builder, Baba, Amazon. And then he decreased positions, some other stuff there. Triangle Investor, it says, what stocks was your biggest loss ever? Well, guys, I've had what I think are complete losses. 100% of my position I have lost. I was an investor in Norilsk Nickel or Nornickel, however you want to call it. They're a big PGM and nickel company with lots of copper and other nice metals in that. I'll call the entire suite of their portfolio was actually very good. But since it was Russia and their sanctions, that position is like frozen. And I don't know if I've lost it or not, but I capped it at what I put into it, which is my position size that I position sized it. It wasn't my largest position, but it was an okay position. I lost probably about 4 or 5% of the portfolio at that time for what that portfolio size was. So that was probably my biggest loss. Is an entire position worth about 4% of my entire portfolio. That's what I would say. Black Silo says, and the cycle is complete. And what we're looking at is wheat prices. We've got our nice little takeoff, first sell-off, our bear trap. Then we go in the media attention phase, enthusiasm, bull trap, greed, delusion, new paradigm. Then we come back and sell off into capitulation and despair. We're actually at a lot of the areas of despair in a lot of the commodity companies, and we're in the stealth phase. So a lot of them have done a breakout, then they do a retest, which is on top of this. This is your despair is the retest move that I purchase. You guys all know that I buy the retest, and then we go to return to mean, where you go back through this again of the stealth phase. Now, where I think some of these other commodities are at, because it's not all of them. There's a lot in this bear trap to media attention phase right now. And you get this guy here, this area is that lead-in pattern that we see before a big move. Uranium, I think, is in the media attention phase. That's where we're at right now. Maybe even some of them are entering enthusiasm. And then we've got a lot of other sectors that are also in the media attention phase that are going to start coming out and getting into media. Could be like your dry bulk shipping and stuff like that. So here is myself. I swapped my palladium in April of 2020 at a very low ratio. Premiums were also low at this point for platinum. Now I've been waiting. Platinum's the cheapest precious metal at this point. It might not immediately outperform, but I am patient. There's platinum versus palladium. Had a big old outperformance of palladium coming down here. I do use these ratios to swap metals. And what I do is I accumulate the metals over time. And I use the ratios to accumulate a larger and larger stack of metals. So what I do is at the top of here, I purchased palladium, wrote it all the way down, and I swapped my palladium for platinum in 2020 of April, which is right here towards this bottom here. The reason I did it there is because it was at such a low valuation or favorable for palladium to swap to platinum that I did it. And that's one of the reasons I did it. It's also, platinum was cheap in 2020 against silver, which was on this point right here. And we can see we're doing almost another double bottom. And then we have platinum versus gold, and that was another point that was really, really low, even for gold to platinum ratio. And I do think that we're going to work our way on up here at some point where platinum is going to start to outperform gold, silver, and palladium all in one shot. That's my hope, at least. So I'm overweight platinum. Now, I don't have all of my weighting, all of my metal in platinum. It's still diversified across the board. I'm just carrying a higher weighting in platinum. And I also think silver's good too. Scrolling down, we got Uselink. Platinum and palladium are now at parity. Correct. Here's Brandon. It says, here's one for all your uranium nerds. Cameco with a confirmed inverse head and shoulders breakout today. The pitch here is that if funds want uranium exposure, they really only have a few options here. Sprott, Yellowcake, and CCJ. Remember, it's all about fund flows. Well, this isn't technically an inverted head and shoulders. An inverted head and shoulders is a bottoming pattern. It's not a continuation pattern. What I would say this is a cup and handle. Now, yes, it's the same thing. Market psychology, it all works similar. The pattern really doesn't matter. It's a resistance level that we hit. We hit resistance, hit resistance, hit resistance, hit resistance. So we hit this resistance time, 3, 4, 5 times. We've broken through that resistance. That is the big deal here. Not necessarily what the pattern looks like that was created by it. But nice break here. It looks fantastic. We've got Kevin here. He says, feeling super bullish on silver. Probably my number one favorite commodity at the moment due to emerging shortage for solar industry and over the electricity industry. The electricity industry makes up a third of silver demand, and growth is now accelerating. Solar industry's new tech is a big consumer and now really ramping up demand. The annual silver demand is greater than the annual supply, so you're running deficits. Silver production is down 2 years in a row. Silver production has been flat to down for the past 10 years and expected to decline this again this year. Investment demand has been down over the last year. Silver stocks are extremely underpriced when you look at SILJ. Typically, would-be investors are busy getting conned into buying crypto and destroying energy rather than investing in it. Meanwhile, the silver fundamentals just keep getting better. Silver squeeze is coming purely due to supply-demand and the many real-world applications that require silver. Investment demand will return with a vengeance as people wake up to this story. It's a phenomenon story and will attract massive investment demand all over the world. India and China will hoard silver, and it will also be a go-to for anyone seeking to preserve wealth and flee crappy fiat currencies from all the countries with broken government finances. Silver is the people's money and will once again be viewed as real sound money. Western government stockpiles have been run down for 60 years, and the jig is up. Time for all the paper shorts to get squeezed. So that's Kevin's opinion, and Kevin used to be, he worked in the commodity area at Sprott. Here's myself talking about home builders. I said home builders turned down before the 2008 recession. Do these charts look weak or strong? To me, they scream strength. Could we still be in a mid-cycle wobble where rates slow things down and affordability is poor? Absolutely. Home builders look very strong to me. And this is the charts that I see when I draw these. They look like they are breaking to the upside in almost all of these charts, is what I see. Going down to J, it says a breakout of junior uranium miners, URNJ, to uranium miners, URNM, would be balls to the wall bullish here. I completely agree with that here, guys. The juniors look really good to take off here. Let's see if we can break. I'm very curious to see if we can break here. I've got a good stake in URNJ and some of the junior mining companies themselves. Corn, beans, and wheat now all above their 100-day moving averages. Charts look great. Plenty of uncertainty still ahead. Funds still historically short. Think they will be forced to continue to cover. So this is corn futures breaking to the upside. That looks really strong. We've got soybean futures breaking to the upside. That looks really strong. And this is also going to drive some of our other ETFs that we watch, like MOO. It will also drive the fertilizers and stuff like that. We see very strong wheat futures breaking the 200-day moving average to the upside. Very strong there. And then this is other wheat futures that are also breaking to the upside. Everything looks pretty good for corn, soybeans, and wheat. Here's KAP ripping it. That'll probably be yesterday. If you're listening to it, but that's ripping. Question to the uranium land. Once Biden signs the Russian uranium ban into effect, what will stop all the Western U traders with material from saying for sale at $2,000 a pound? DOE won't issue waivers unless all available sources are tapped. What stops the parabolic move? I asked this a while back. If we actually get into a very big shortage, what actually stops the move? If real physical pounds aren't coming for years, like, do we just send this thing to the moon in the Sprott Physical Uranium Trust? We just all pile into the Sprott Physical Uranium Trust and they have to go buy the physical uranium? And then what does that do? It keeps a bid underneath it and just drives it all the way up until someone shakes some pounds somewhere, but there's only so much you can shake from the tree before the pounds are all gone, is what I'll say there. Barry says, nat gas, data centers don't shut down when the sun goes down, Worth said. We need to have the ability to provide baseload supply for all of these needs. I think natural gas will be a big part of that equation going forward. I agree with that. Now, I saw some people that said natural gas is not baseload power, that uranium is. And I hate to break it to people, but uranium is 10% of the electrical grid. Natural gas is 45%. You've got your numbers wrong. Natural gas is providing baseload power as we speak, and it's also a swing producer. The thing that I get worried about is our grid is getting ever more susceptible to weather. We've got all this solar, which is weather dependent. We've got wind, weather dependent. And then we've got natural gas, and the price of natural gas is weather dependent. And it's also dependent on if the weather is spinning the turbines, and if the weather is conducive and sunny for solar. Now, there's also other weather that can destroy solar, like hail and hurricanes. So we are very subjected to a lot of weather when it comes to our electrical grid now. It's very fragile, is what I'll say. So here's Dow equals 1. This is silver with the CNH breakout my initial target's around 160. There's the breakout. Now, this was from April 6th, and we're about 2750 right now. We're consolidating on top of this breakout. And I just had to share this again because it's that huge cup and handle pattern from 1970s was the lead in here. 70s was the lead in, and then 80s, 90s, 2000s. And this is going to get real interesting here, I think. This is probably, if you're not watching silver and you don't know about this chart, like, this is the big kahuna, guys. Like, this doesn't come in everyone's lifetime. It's so rare to have this type of setup. It says, what a rare breed. Wheaton Precious Metals is a special kind of miner that can keep up with the price of gold adjusted for inflation. Well, it's a royalty company that gets royalties, so it's really priced off of the price of gold and or the price of silver. And it has outperformed gold itself. This is gold versus CPI, and Wheaton tracks that very well. That's also why I think it's a good play to play it, because it tracks it well and it provides a leveraged return against the physical metal. Tavi says, this Monday was a good reminder that the big short today is the debasement of fiat currencies. So I just want to read through some of this. So the first cycle, we had falling gold production, an inflationary regime, central banks were accumulating gold, and a lack of new gold discoveries is what caused this move. The second cycle, we had falling gold production again, Golden's S&P 500 ratio at historical lows, and China driving commodities demand. Now we've got this big third gold cycle wave that is coming. And look at the confluence of all of these events that are leading to this gigantic gold bull market that's ahead of us. We've got falling gold production like every other time before. Central banks are accumulating gold like the 1970s. Government debt at historical levels. Unsustainably high fiscal deficits. Rising deglobalization trends. G7 economies entering a manufacturing revitalization era. The onset of an inflationary regime, which was the 1970s. 60 to 40 portfolios looking for haven alternatives. Ultra capital conservatism by major miners. Lack of new gold discoveries. And gold to S&P 500 ratio at historical lows, and a trifecta of macro imbalances, debt problem of the 1940s, inflationary issue of the 1970s, and asset valuation imbalance of the late 1920s and 1990s. So we have all of these things combined that did not occur at other market gold cycles. We did not have cheap mining companies in 2000 to 2011. They were still falling against gold itself. So I think that there's the possibility where some of these mining companies could do crazy things. It's possible. And that's also with these big patterns that are in the physical metal itself, like the silver one here. We could see some really crazy stuff. We're talking about going ballistic, Goose. Coming on down, the second wave has begun. The U.S. compares simply are too hard by mid-year. Some form of divine intervention is needed. By quarter three, it will be clear. It says, are we sure that the UK inflation wave is over? We can see a big move higher here, and we're seeing that in the charts. We're seeing it on these falling wedges that are starting to break to the upside across the commodity complex. Such great entry points. And this is probably the beginning of the second wave. I've got a lot of charts here. So SILJ versus GDX, silver juniors are starting to break out against GDX. That's pretty interesting here. SILJ could be a real big winner here for potential investment. We've got SILJ versus silver. That does look like we're putting in a double bottom, and that could start to work its way on up too. So SILJ, which is the juniors, could be some of the cheapest assets in the markets these days. Here's the 2-year yields, higher or lower. Gold is kind of saying lower, but could we go lower and gold go higher on the 2-year yield? I think that's definitely a possibility. We've got iron ore as a low, low, low. Livermore accumulation cylinder, perhaps. 1, 2, 3, 4, 5, 6, and then 7. And that's where you get the big surge to the upside. And what would cause that? Well, if we had a big surge in building our grid out, all of those posts are made from steel and iron ore. is in that. We also can see a potential big move in silver because silver is part of it, and copper. And what do we see? We're seeing all of the metals that are linked to electricity growth. They're all putting in these patterns and about to go higher or are already going higher, like copper. Uranium looking strong, URNM looking strong, URNJ looking strong. Therefore, we are strong for uranium. And we're starting to break out, which is really good for all of these. Now, we could get a retest, totally possible, but the momentum is to the upside. Looks good. Silver looks solid. Platinum trying to break out. Gold is running. So silver is breaking out on a longer term time frame. Looks very good for a big monster run. And again, remember, monster patterns change lives. We've got platinum that's also trying to break out. Looks very good. And then we also have gold futures that have already broken out and are running. So there's your confluence of information on the precious metal sector. They all look really good. And we already talked about that one, URNM. Chevron CEO, we see risks to the upside for oil prices. When I look at the charts, they look a little bit weak in the short term, but I do think on a little bit longer term, definitely, totally right. As I watch, so this is what he says here, as I watch gold and silver stocks threatening to break out to new highs for this move, I'm also writing away on my investment book. Here's a little tidbit I was noodling on today. Actually, I think I already wrote that one again. We'll end it there, guys. So that's what I've got for today, guys. Give me a thumb up for the content. Subscribe to the channel. Subscribe to the website if you'd like. And we'll catch you later. This is Finding Value.